We've seen a number of strategists, Goldman Sachs coming out and seeing the potential for a 15% gain in raw materials over the duration of this year, in part because the Fed is going to allow growth to continue.
Correct.
Mike Wilson over at Morgan Stanley also talking up the likelihood that a commodity-oriented cyclical boom really gets ignited. At what point does this become a problem for the broader market with the idea of inflation coming back?
Well, I'm not that worried about the inflation story because I think certainly on the good side, China is going to continue to export deflation. We continue to see that their producer price index is negative. We continue to see that import prices for the U.S. coming in from China, those are negative on a year-over-year basis. China's in a pretty serious recession. They're really in a property depression, kind of similar to what happened in Japan a while ago and in the United States. And it takes years to offset or to come out of that kind of deflationary experience. So I'm not particularly worried about price inflation. I'm more concerned about asset inflation. You know, it's not just the stock market that's on a tear. It's also gold, it's Bitcoin. The spread between high yield corporate bonds and the treasuries is extremely narrow. So that's where the Fed's running a risk here. I think there should be three mandates. If they're going to have a mandate to keep inflation down, price inflation down, keep unemployment rate down, they also have to be concerned about financial stability.
Ed, when you look at the take from Mohamed El-Erian, and he told us on Friday it might not be this pinpoint when it comes to inflation. Maybe the Fed is now targeting a range. And he said last week was a really good moment where potentially you saw that shift. Do you agree? Do you think the Fed is now looking at a range instead of 2%?
Well, it seems more like that based on what Powell said, that their target is still 2%. They're not putting that in a range. It's just Powell kept saying over and over again that they're shooting for 2% over time, 2% over time. He said it several times. And that implies that they're willing to lower rates before they actually get to 2%, whereas the message before seemed to be that they're not going to lower rates until they're actually at 2% or so close to it and so comfortable that it's going to stay there that they can go ahead and ease. So I think the message right now is pretty ambiguous, quite honestly. It does kind of make me wonder, you know, what do they know that I don't know? What's the rush to lower rates?
The answer to that, Ed, is maybe nothing, as you know, because they're often surprised by many things. And I just want to know, given everything you've said in the last 5 minutes or so, what are you advocating for in equity markets? What are you advocating for now, from here to year end?
Well, I'm still going to use 5,400. I mean, obviously we were only, you know, what, 2-3% away from that. But I think it's still a bull market. I think in next year we'll be looking at 6,000, maybe 6,500 by the year after that. So I think we're still in a bull market, and I think you stay invested. And if we get a melt up, well, we'll have to discuss whether it's time to take some profits before a meltdown. But that's a risk scenario right now. It's not the most likely scenario.
So where does the financial stability point come into play? How concerned are you about that?
Well, I think it is kind of like the 1990s in that regard, but it's not 1999. It's more like 1996. So we may be early on in the financial instability issue here, but things move pretty quickly these days. And everybody knows the history of the stock market. They knows what happened in the 1990s. And if the Fed really, you know, gives us a rate cut before we're expecting it, I think you'll see the market moving a lot higher.
How much are you concerned about bonds waking up to the idea of something of a range, of the idea of stickier inflation?
Right. Well, I think the bond market is happy to see the inflation coming down. And I think the bond market's struggling the way all of us are with the Fed's message. What do they really want to do here? You know, the FOMC statement made it sound like we're going to wait until we have the data that gives us confidence that inflation's coming down. And Powell modified that statement by saying that, you know, things probably aren't going to work out in that direction.
Ed, this just sounds like extend the cycle, which raises a question about the cycle that I'd like your input on. Hear a lot of people come on this programme and say we're late cycle. I think Lisa's asked the question a few times. Just how late are we actually, Ed, given the conversation we're having?
Well, I think we've discovered over the past couple of years that history doesn't always repeat itself, but it does rhyme. And we are, I think, somewhere in the middle of the cycle. I don't think we're late. I think the economy is still showing plenty of signs that inflation is coming down. But you have to put everything in a global context. It's not just the same old U.S. business cycle. You have to put it in the context of what's going on in China, what's going on in Europe, what's going on in the geopolitics.